This November, 435 House and 35 Senate seats will be up for election in the U.S. And while midterm elections shape our political landscape, they also have real implications for financial markets. In fact, U.S. stocks tend to follow certain patterns during midterm election years. So what can investors expect as the election draws closer? Number one, expect periods of uncertainty. When it comes to midterm elections, the key market driver isn't which political party wins, it's about the uncertainty that comes with the unknown. And investors don't like uncertainty because it drives volatility. Number two, while returns often dip before elections, they tend to rebound after. Over the past 24 midterm elections, data shows that market returns tend to be more muted in the 12 months prior to election day, but then experience a relatively robust period in the 12 months following it. What causes this pattern? Questions surrounding taxes, government spending, and regulations create a good deal of uncertainty ahead of the election. Then, once voters finally cast their ballots, the investment landscape becomes clearer. Investors go back to putting money to work. One important point here is that these patterns have very little to do with which political party wins or loses. Regardless of the outcome, history shows that stocks generally rise after elections. Essentially, the market is just relieved to finally have clarity on what the political environment will be, and that's why it rises once election day is over. Turning to our final common pattern that we observe during midterm election years. Certain sectors are positioned to benefit from tailwinds either leading up to the election or in the period following it. Going deeper into the market dynamics, historically, certain stocks tend to hold up better ahead of election day when volatility and political uncertainty typically rises. For example, sectors like consumer staples, utilities, and healthcare tend to fare well in uncertain environments. Additionally, stocks that are high quality, have low volatility, and produce dividend yield have also historically navigated the months before an election effectively. However, after the election results come in, the tide typically turns and a different set of stocks benefit. More cyclical and growth-oriented stocks like those in technology, industrials, and consumer discretionary sectors tend to see upside as investors gain clarity about the broader regulatory and policy landscape. So, what should investors do in this seesaw midterm market environment? In our view, investors preparing for midterms need to stay disciplined and diversified. They should consider allocating toward defensive and growth stocks. By gaining exposure to these areas of the market, investors may be more prepared to weather the volatility of the midterms. But most importantly, history shows that despite our respective political biases, stocks tend to climb over the long term in all sessions of Congress. Staying the course with your long-term investment strategy is a plan of action worth voting for. If you have questions about how the midterm elections may affect your investment portfolio, reach out to your Ameriprise financial advisor. Thank you.